Unfortunately, not much has changed. The September Westpac Melbourne Institute Consumer Sentiment Survey showed the headline index down 0.5%, down to 84.6, so still in deeply pessimistic territory, around the range that we've seen for over 2 years now. Where there was more happening though was around the survey detail. What we're seeing is some improvement around family finances, slower inflation and tax cuts and other fiscal support measures do look to be providing some relief. But it's coming through very gradually and from a very weak starting point. Consumers are also less fearful of interest rate rises, particularly compared to a couple of months ago. Less than half expect interest rates to be higher over the next 12 months, and that seems to be providing some sort of support to their forward view around family finances, which is broadly expected to stabilise over the next 12 months. But those improvements this month were more than offset by renewed concerns around the economy. We saw midway through the survey week the release of the June quarter national accounts update that showed GDP growth slowing to a crawl, barely 1% over the year, and consumer spending weaker still, declining in the June quarter and annual growth slowing to just 0.5%. And that was particularly weak given the strong growth that we've seen in population. In fact, record growth in the quarter and annually rising to 2.5%. And that data update definitely weighed on sentiment. Amongst those surveyed during the survey week, we saw a sharp drop-off following the release. In fact, all of the weakness month to month was concentrated in those that were surveyed after the GDP update. And that looks to have sparked some renewed concern about where the economy is heading over the next 12 months, and in particular how that might spill over to jobs. The Westpac Melbourne Institute Unemployment Expectation Index, which is based on questions about whether people expect unemployment to rise, stay the same or fall over the next 12 months, deteriorated significantly in the month, about 3.7%, and now it's materially above long-run averages. Also notable, the deterioration was a bit sharper amongst those who have jobs, and that's an indication that perhaps the weakness that's happening in the economy and how that's affecting businesses is starting to raise a little bit of concern that we may see some layoffs. Now, it's not panic stations by any means. We're still only above average. We're not spiking around unemployment expectations, but I think that's an important wind shift and it bears watching closely. If consumers do get very concerned about jobs, that's something that could trigger another bout of caution and restraint, even though we've seen plenty of that over the last 2 years, that could prolong the period of weakness. Around the housing questions in the survey, it was a fairly familiar set of responses. Price expectations are still quite bullish, although they've come off a bit compared to a couple of months ago. And assessments around time to buy a dwelling still at around cycle lows, although they did improve slightly. What we're seeing around the housing side of things is a widening divergence across the different state markets. The medium-sized states that are seeing prices boom at the moment, assessments of time to buy have deteriorated and price expectations remain quite upbeat. Whereas in New South Wales and Victoria, where conditions are quite a lot softer, those assessments around time to buy did rally quite sharply in the month. Still very pessimistic, but they've improved and price expectations are coming off a bit more in that space. So it's consistent with our Housing Pulse update, which showed a widening divergence in performance across states. So overall, still a disappointing picture around the consumer. We're starting to come into that lead into the Christmas New Year periods, probably still about 10 or 11 weeks away from the Black Friday sales period that really kicks that off. But given where the RBA is at the moment, we're unlikely to get a supportive move from the Reserve Bank between now and the end of the year. And this picture around sentiment suggests that the improvements that are happening around cost of living pressures are still very gradual, and there are other concerns that are in frame. So at this stage, it looks like this consumer austerity is going to be with us probably for the remainder of this year. And we'll look to 2025 to hopefully get a break.
The content of this recording is informational and of general nature only and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.